I can't help myself but come in here and antagonize you at 8:45 in the morning and ask you, Thomas and Tony, what is the value of a price target to a trader? Does it do more damage than good? Can it result in cognitive bias like anchoring? What do you say to traders, in particular new traders out there, who see these price targets? What's the value, Tom?
The value is zero. The value is zero. So before, your last question was about gold, and where do you see like gold going, or what's moving gold market, that kind of thing. And I suggested that obviously I don't care because I don't care about gold, but you've actually found a topic that is even lower on the totem pole to me than where do I think gold's going. Like almost thought it was impossible, Mr. Jones, for you to come up with something where I could say it even has less importance to me and less value.
Okay.
I mean, remember, I'm a product of going all the way back into, early 80s when there used to be, when people actually believed that analysts had some idea. Like I know now the analysts know, after running, a public company, I know that analysts have no idea of anything. But at first I used to think, when I was like raw, I used to think, oh man, maybe this person actually does know something. And then over the years, I began to realize, oh my God, this is just all PR. This is just so you can get a quote in the Wall Street Journal or whatever else it is. There is absolutely, a price target means absolutely nothing. You will do 100 times better by giving a price target based on expected move. Because if you want an actual price target, just take expected move, and if you're bullish, take the upside of what expected move says, and if you're bearish, take the downside of the expected move, and you're going to have, anywhere between a 30 and 40% chance of being right, and that's as a target, and that's impressive because that's the actual statistics. But anybody that just gives out a stupid target, like the one guy that lowered Tesla from 345 to 325, or NVIDIA to 1,000, like do you know the chances of NVIDIA hitting 1,000? If that's your price target, is 100%, is 99% based on real statistics. Like I've gone through this stuff 100 times. Price targets by analysts, that's what they get paid to do. I get it. I agree. I argue it's for litigation reasons and nothing else. And it's also so that their reps have something to talk about. But they have no value, zero value in the traders' world, zero.
And by litigation, you mean that if they get somebody into the stock, they could say, well, it was supported by our research. Here's our analyst report.
Exactly. Like the guy that's going to, the guy that says NVIDIA is going to 1,000, now they're getting their customers to buy NVIDIA at 900 because the analyst says it's going to go to 1,000. So now they have reason to, it wasn't just a crazy, commission grab.
A rogue commission broker. Yeah, I guess.
Exactly.
Or financial analyst. Yeah. Right.
But Victor, to answer your question, as a trader, no, there's no value.
Okay, so now let's go here. Tom, if you were to put out a video right now, super bulled up on NVIDIA, you talked about some upside price target, and financial content creators do this every single day. Every single day, whether you're a financial content creator or anything else, you do an A/B test. I can tell you, after doing this for 15, 20 years, here's what happens in a bull market like this. You put out a video that says NVIDIA to 1,000. You want to know how many more clicks that gets? Then here's how to evaluate the expected move, and here's what you should expect between now and option expiration, or now and 2 OPEXs before it doesn't perform until volatility comes. So my question to you is, as somebody who creates financial content for people and navigates the financial media world, how do you stay disciplined? How do you make sure the firm stays disciplined in the message, not chasing the view, and instead staying disciplined about teaching people about thinking about risk, especially staying disciplined in a crazy bull market where you've got people making insane upside predictions and people effectively saying that whether it's government spending or monetary policy support, that this thing, you've almost got this moral hazard type of feel in the marketplace. And it would be a lot easier, Tom, to make financial content and videos that just say number goes up. And I'm telling you the performance would be better, but that's not the ethos of this firm. So how do you keep the integrity in a market like this to make sure that you're talking about risk, you're talking about probabilities, instead of just massive upside where you can A/B test and do into success?
Yeah, that's great, because that is, that's ultimately why we have been so successful in what we've done. That's because smart people can see through it. Smart people can recognize, there's a reason why they might get 1 million clicks. That's why people will, watch CNBC, but it doesn't open any accounts or generate a trade lift or doesn't really create engagement. It just creates clicks or eyeballs. It doesn't mean anything. There's a big difference between actionable content and clicks. And it's a distinction that a lot of people have a hard time with. Like I can get 1.5 to 2.5 million views on a TikTok video about talking about where some stock's going to go. I completely agree with you. Or just like I can get 50 to 100,000 views on eating a fish sandwich in my car. All right. But I might get 197 views talking about expected move as it relates to, what I'm expecting Costco to do this afternoon based on expected move. And it might get 197 views as opposed to 1.7 million or opposed to 55,000. But those 97 views are way more valuable, or 197 views are way more valuable because people are actually, it's actionable. It's engaging, it's actionable, it's intellectually challenging, and it's real. And so, it just depends on, I mean, we've proven that is way more valuable, but, that's just my 2 cents.
I am, look, I'm not saying I agree with you or anything because that would be a major departure of what this segment is supposed to be. But there is a part of me that I find it really hard to get on board. And I'm not saying NVIDIA is not going to go to 1,000. I'm not saying Bitcoin's not going to go to 300,000. I'm just saying that that's not very interesting to me. To me, the game is about finding the relative value. To me, it's about finding the opportunities that people don't see coming. The easy sort of one-way momentum trades, they work until they don't. And as long as if you've got a tight mechanism for defense and risk management, then sure, that's your style, that's your style. That's never been my game. And I know what happens in these one-way bull markets, the relative value, the staying disciplined, the looking for opportunities with lower beta or potentially less risk on the table, or finding high probability smart beta plays. That's not going to get the clicks, but I don't want to chase those things. I want to talk about what I think matters to people, because it always comes back, Tom. At the end of the day, when you get the break, all those people that were telling people to to buy that FOMO, let's try to get this last $100 on an NVIDIA rally, it always comes back to hurt those people. And the people that they get encouraged to buy those instruments at those moments, I'm not in any way saying we're at a near-term top for these instruments. They get hurt. And they get hurt, they get angry at those content creators. But the content creators that are helping people navigate probability, relative value, and sort of smart placement of beta, in my personal opinion, those are the people who develop long-term relationships with the end customer. The customer the viewer ends up trusting those people a lot more than the one who says, hey, go out and buy AMC because we're in a fight against short sellers. Where are those content creators now? And their audiences are probably not very happy that they're holding the bag right now. So in a way, I'm agreeing with you without saying I agree, Tom.
It's good,
because you would look like a loser if you agreed with Tom. We don't want you to do that.
It's a fascinating topic, something that Dylan and I talked about this a couple of years ago, but we haven't covered it in a long time. But I fight, to show you how crazy this is, I don't fight, but I have this conversation with marketing people, with branding people, with other people that run different companies, with marketing partners. And it's so interesting to really, when you get down to the nuts and bolts of how content is really valued or how it's absorbed. Obviously the Facebooks, TikToks, and YouTubes and stuff have created this, multi-trillion-dollar asset class from short form content. But for others trying to monetize it, again, other than eating a fish sandwich in your car type thing, you know, it's very difficult, especially in the world of finance. And you can see this from like the troubles that Bloomberg has had, the troubles that CNBC has had, the troubles that Wall Street Journal has, the troubles that New York Times has, you know, the trouble that financial media has, kind of traditional financial media. You can see how difficult it is. And I think what we've done at Tasty from inception is we have absolutely changed the game of financial content. Like if you go Google something on financial content, you will find a long form piece of Tasty research from our think tank. If you look at 20 years worth of stuff, we're out there everywhere. We've created hundreds of thousands of hours of long form content that nobody else has ever done. And we've done it for free. And that has changed. I'm going to argue that what we've done over the last 13 years has changed the world of derivatives, and also, you know, has led to a real growth in the space, even though the marketplace is minuscule.